Sudhir Singh, the CEO at Coforge, joining in on the show right now. Sudhir, you've announced your largest ever acquisition, which is going to add about 20% to your top line. But the street is worried that you've bitten more than you can chew with the execution risk. Help our viewers understand the strategic rationale behind this buy.
What this acquisition does for us, we think of it fundamentally as a game changer for Coforge going forward. This acquisition does three important things for us. Number one, it will allow us to stand up three new industry verticals. The retail vertical of the merged entity is going to be operating almost immediately at about 100 million US dollars per annum. The healthcare and the high-tech verticals of the merged entity from day one will be operating at about 50 million US dollars. In some cases, more than that as well. So that's number one. The second thing that this acquisition does for us is it fills in the geographical blind spots that we've had across North America. Signity has a significant presence across the Southwest, the Midwest, and the Western US. Coforge has traditionally been very East Coast centric. So this allows us to fill in the geo-based gap areas that Coforge had. It also, of course, brings in 28 Fortune 500 new customers to us. And the intent there is to make sure that not only do we sell digital assurance and digital engineering that the Signity team has been doing, but we also sell in the other 9 service lines that we have. And finally, number 3, what this acquisition will do for Coforge is it will allow us to address the AI-driven imperatives around assurance services.
So can you confirm, is it ETS accretive from day one?
It will be EPS accretive from day one and therefore year one. Absolutely.
For funding the acquisition, you will be doing a QIP. Could you help us with the quantum and the timeline of the same?
The QIP process is going to be triggered near immediately. We would like to, if the market supports it, close the QIP within a month itself. Our intent is to raise roughly about 250 million US dollars, and we will acquire between 51 to 54% of the promoter stake through the QIP. The rest is going to be effected through a share swap post the QIP closure and the 51 to 54% tranche being picked up.
Right. Okay. So that really is the take coming in. The other thing I wanted to understand about the margin front as well, because there's been a bit of a disappointment there in Q4, and given Signity integration, it might stay under pressure. What do you have to say about that?
The Signity PAT is actually slightly higher than the Coforge PAT. If you look at the FY24 results, their PAT came in higher than us. Their EBITDA is lower than us. We believe that the merger synergies, and both teams have spent significant time through the due diligence process to think through that, will allow us to materially enhance the Signity EBITDA as well. We believe year one itself, which is FY25 from our vantage, post-merger, Signity EBITDA also should start getting fairly close to the Coforge operating EBITDA.
You've not given a guidance for FY25. Is it fair to say that it will be at least in single digit?
Well, last year, when you look at the forecast that we did provide, we ended up being one of the only, if not the only tech services firm which gave a very definite revenue guidance range at the beginning of the year and delivered on it, which is why we've delivered 13.3% CC. This year, and not just this year, if you look at our track record over the last 7 years, the order executable number, which is the next 12-month signed order book number that we call out every quarter, and not everyone does, the 7-year history of the movement of that number shows a very tight correlation with the actual revenue realized over the subsequent 12 months. We believe, from a market perspective, the fact that we will continue to call out that number every quarter is a better surrogate for where the firm is going than just giving an annual revenue number at the beginning of the year. Last year, when FY24 started, we walked into the year with an order executable that was 20.7% higher YOY, and we delivered a 13.3% revenue number. This year, as we get into FY25, we are walking in with the order executable 17.3% YOY higher. And we will keep reporting on that number every quarter.
Right. You know, the other thing also that I wanted to understand was about execution risks that you foresee for the Cigniti acquisition.
I mean, Coforge, if you look at our history, has done 3 acquisitions over the last 7 years. We have never failed on any one of those acquisitions. And we set a very high bar for ourselves when we called something out as a success. 7 years back, we acquired a $13 million Pega asset. That's a 100 million plus business for us today. 5 years back, we acquired a $22 million MuleSoft asset. The Salesforce practice today for us is more than $70 million. 3 years back, we acquired a BPS asset, $73 million, in the mortgage servicing space, which is a space that has seen significant demand headwinds, and yet that business today is $110 million. We've always said this, we are in the business of delivering results, not excuses. As far as Cigniti is concerned, we walk in to this acquisition with tremendous confidence, not just in Coforge, but also in the Cigniti team that we've interacted with. And we've interacted with level 1, level 2, level 3 management folks, and we feel really, really good about the caliber of that team, the commitment of that team, and the passion of that team to create a horizontal AI services platform. More importantly, to mine all the existing client relationships that they have.
All right, appreciate your time and thank you for joining us.
If you like this video, then like, share and subscribe to ET Now.